In this video, with a straight face, this isn't me exaggerating. I'm actually just going to get real at this point. I'm going to give you a series of schemes, plays that I have used in crypto for years to repeatedly turn hundreds of thousands of dollars into many, many millions of dollars in crypto that you can then apply to whatever amount you want to invest. But more importantly, I'm going to show you how to do this on your own.
Alex Becker, the crypto Twitter whale, has come out with his investing plan for the upcoming bull market. In this video, I will summarize his plan and then go over everything he missed and what you should know before the bull market begins. Before we hop into the video, this video is not financial advice and is for educational purposes only. Investing in cryptocurrency is risky. Please consult a financial advisor before making any financial decisions. If you enjoy my content, make sure to like the post and subscribe to not miss any videos in the future. Less than 1% of you are subscribed. Let's get that number up. Now let's take a look at Becker's investment strategy. Alex's investment strategy is broken down in this video that he posted to his YouTube channel that has over 200,000 views. In this video, he has 5 main points which are holding period: narrative trading, rotation trading, Lindy effect, and liquidity. The first thing Becker talks about in his video is to not view these coins as long-term investments. There are no dividends that will be paid out. These investments are almost entirely speculation. You should not be holding them for longer than a few months, as most of these coins will end up being worthless. If you don't believe me, look at the bottom 1,000 coins on CoinGecko, or look at the charts now for the best performing coins from the 2017 bull market. It's a graveyard. The second thing he talks about is how crypto trades based on narrative, and not on expectation of future cash flow the way stocks do. The coins need to have a convincing story behind them. For example, layer 1s in the last bull market, this narrative was that they were going to overtake Ethereum because of their faster speed or lower transaction costs, or better marketing or different consensus mechanism. Even if they don't reach the lofty goal they set for themselves, these coins will still trade high because they trade on emotions of humans. As the crypto market matures, more sectors are popping up, meaning that it is becoming impossible to be aware of everything that is happening in the market at once. Because of this, it is very important to master one niche so that you can be adaptive to when the market changes and to make some connections, who are experts in other niches. Becker calls the third pillar of his investment strategy when the grandpa moves. This is essentially the Bitcoin dominance alt season thesis. The first coin to move is Bitcoin, and that sets the mood for the rest of the industry. Profits flow down from Bitcoin into mid-cap coins like Ethereum and Solana, and then to smaller and smaller coins, and because of the decreased floats of these coins and thinner liquidity they pump, this cycle happens multiple times until there are micro coins being pumped, and once those stop, the market crashes. Being able to time these rotations will make you lots of gains. Old hero veteran tactic. This is the idea that marketing is important and that brand names will pump easier because people remember them. This is also important because it emphasizes the intelligence of the teams running these projects. Lots of crypto market participants left the market in 2022 and will come back in 2024. The only issue is the whole ecosystem has shifted. There are new coins and new narratives to trade. This can get confusing. If the new participants are looking to buy something quickly, they will revert to what they bought in the last bull run. Alex makes the point of Illuvium because it was a big name in gaming last bull run and is still around. The fact that it is still around is a testament to the quality of the team, showing that they are able to navigate through tough times in the industry. Liquidity. In the last bull market, coins that went up thousands of percent were not uncommon. But one issue is, when it comes to selling small caps, there is not much liquidity. Meaning that if you were to sell a big percentage of the market cap of a coin, even just a couple percent of the total supply, you would crash the price greatly. This is why you need your investments to be spread between multiple coins. For example, the people who made hundreds of millions or even billions off of the historical run-up in the Shiba Inu coin, they couldn't cash out that position because it would crash the coin. If they had 1 billion in the coin, they could maybe get 100 million out. This is because the liquidity pool was so small compared to the market capitalization of the coin. If you are wondering how much liquidity your coin has, you can go on CoinGecko, go to the market section, and go to the coin you hold. For the sake of example, we will keep talking about SHIB. You could spread your trade out around a few exchanges but you would likely get front-run by arbitrage traders. So let's say that you want to sell your 1 billion worth of SHIB on the most liquid exchange, Binance. There is 1.3 M in depth to the downside to incur a 2% price impact. So if you sold 1.3 M, the price would dip by 2%. So you can see how selling a big amount will have a big negative impact on the trade, not allowing you to withdraw the paper value of your position. Now time to cover what Becker missed in his investing plan. In this section, I will cover a few things. I will cover the importance of a cult founder, new narratives, tokenomics, friction, and then finally risk management. As Becker stated before, crypto is the trading of stories at this point. You can't have a good story without a great main character. It is important to have that person who can bring eyeballs to your project. Thousands of coins will launch every year to the public, and everyone with an internet connection has a chance to participate. This means that there is going to be a lot of competition for attention. If you can harness that attention, it will lead to investment in your project. Whether we like it or not, people like to invest in people. When you buy into Tesla stock, are you buying the future earnings of the car company? Yes. But what you are buying into more is the ability of Elon Musk to tackle the challenges that stand in Tesla's way of becoming the #1 car manufacturer in the world. This exists in the crypto world as well. If a project on Ethereum has Vitalik's approval, you bet the community is never going to let you forget that. Vitalik is great, and his name holds a lot of weight in crypto. But there are people who are way more charismatic than him. And that's not saying much. If we look at coins currently and in the past that have had huge market caps, lots of them share this quality. Luna, before it unwound, had Do Kwon, who did a great job of bringing the community together, debunking FUD and gathering new investors. One of the best examples of this is Daniele Sestigali. He took the Avalanche platform to new highs in 2021 with his technical knowledge and charismatic personality. He popularized the term WAGMI, which stands for We Are All Gonna Make It. He made the Frog Army and pumped billions of dollars of market cap into his projects. People loved him.
I think the Frog Nation is more of a concept. Like, there is no token. This is important. There is nothing to ape in. The Frog Nation is more the idea that no matter which chain you like, or which project you like, or what ethnicity you are, or where you're from, everyone should have the same opportunities in life. And together is the only way in which we can ensure that these opportunities are truly for everyone.
Just take a look at some of these YouTube comments. You should be on the lookout for these characters. Even if their projects aren't the best, their magnetic personalities will pump the price. This, in my opinion, is more important than fundamentals. Most retail participants won't spend hours researching a coin. They will just follow their favorite project leader on Twitter and ape into their project. People don't change. This bull market there will be a new pack of charismatic leaders to lead their projects to the moon. But remember to not fall for the marketing. Stay rational. In past bull markets, there have been narratives that have blown up and lost steam. One of the great things about crypto is that there are always new narratives. Some of the coins that Daniele was working on were new narratives, like his Olympus DAO fork called Wonderland. Old narratives are more consistent and likely to regain steam because of familiarity, but they won't pump as high as new narratives will. For example, last bull run, the same narrative played out on every layer, one that had an ecosystem fund. The leading decentralized exchange would pump more than the underlying coin. On Avalanche, this was Trader Joe. On Polygon, this was QuickSwap. On Binance Smart Chain, this was PancakeSwap. But there were also narratives that were new last bull market. For example, Unisocks, the NFT attached to popular decentralized exchange Uniswap. Unisocks were digital socks that could be redeemed for a new pair of socks. The NFT started at $60. In the 2021 bull run, it ran up to almost $150,000. How do you value a pair of socks related to the biggest and most culturally significant decentralized exchange? Are they a collector's item for crypto whales? A piece of art? Worth less? These questions can lead the price to very odd places. This is what happened in layer ones as well. They are hard to value rationally, therefore they are easier to pump and form a narrative around. Another important aspect of investing to be aware of is tokenomics. If you are investing with medium to long term in mind, then this is very important. If you are not holding for long, it is less important. But there is one part of tokenomics that everyone should pay attention to no matter their investment horizon. This is the unlock schedule. The unlock schedule tells you when coins will be coming onto the market from vested holders. These are usually venture capital firms that invested early on in the coin and are now looking to cash out. Some of the other things to look at in regards to tokenomics are, what are the demand forces on this coin? Meaning, why would people hold this coin other than for speculation purposes? Then you should look at where supply is coming onto the market. If the supply is going to outpace demand, that is not a good long-term sign for the coin. If you want to see how I analyze this on specific coins, check out the other videos on my channel. Now we will look at friction. Friction is the idea that every level of complexity it takes to buy a coin is good, because once it gets uplisted, for example, from Uniswap to Binance, there will be more people ready to buy. This is one of the reasons why people bridge and transfer into the depths of Layer 2s and obscure Layer 1s for the hope that one day the coins will be uplisted to a Tier 2 or Tier 1 exchange. There are countless examples of this working in the past. For example, Harmony 1 blockchain. This is a smaller Layer 1 that was doing well in the last bull market. They had a game on it called DeFi Kingdoms ticker Jewel. This coin was objectively a lot of effort to get. You had to bridge to Harmony, and then go on to the decentralized exchange in the game and buy the token there. But it did end up getting listed on second-tier exchanges like MEX. The last thing I'm going to cover is one of the most important things that nobody talks about enough. They only talk about coins mooning. It is important to manage your risk. Don't buy certain chart patterns. Make sure you size your positions properly and spread your risk around exchanges. You need to always be skeptical in the crypto industry because once your money is gone, it's likely gone forever. In crypto, there are risks around every corner. There is the risk that coins will get hacked, the risk that your wallet will get hacked. These hacks are easy to avoid. The first step to keep your coins safe is to not keep your coins on exchanges. Last cycle, we saw a bunch of exchanges and other projects blow up and take their customers' funds with them. Most notably, FTX, Celsius, and BlockFi. There were big traders who lost all of their money because they held it all on FTX. This could have easily been avoided if they were more thoughtful with where their money was. It doesn't matter how great of a trader you are if your funds disappear when the exchange you trust with your money goes under. The second type of risk that you should be aware of is when you are investing into coins that are on-chain. Always double-check the token address of the coin you are investing in. There are people who make coins with the same name as Big Meme coins. They will take those funds and Rugger will catch you in a honeypot. A honeypot is a coin that you can only buy. The chart will look something like this, or it can look like this if the developer is more sophisticated. These contracts don't allow you to sell, so you essentially lose 100% of your money the second you invest in it. You can check if a coin is a honeypot by using a website called d.fi. This will tell you if a token is for sure a scam. But it doesn't cover everything, so still be careful. You should look at crypto as a video game. Squat up, become part of a community. It's hard to keep your eyes on the market at all times. It's good to have people you trust also looking into things. You can share notes and win together. If you like this video, hit the like and subscribe for more crypto content. Until next time.